Hello everyone, welcome to a video that's going to walk you through the challenge DIN. Now we left this in class because we didn't get to finish it, so I'm going to walk you through how to complete it. Now in class what we did do is we went through how to complete a common size, okay, a vertical, and a comparative, which is also horizontal analysis for a balance sheet. So we would have gone each line, so in this case the cash, divided by our total assets or our total liabilities and owner's equity. Remember that we can use either number because they're the exact same if you're using a balance sheet. At least they should be in order for the balance sheet to balance. Okay? So we need to divide this by the 5 million. Make sure I've got the right number. And as a percentage. Okay, and all we're doing is we're representing these as a percentage of total assets. So 3.77% of my total assets are cash. That's the way to read that number. Okay, and then we would do the same for every single line. Now, since I went through this in class, I'm just going to use my Excel to do this as quickly as possible. Okay, we'll get rid of some zeros that we don't need. Okay, and I'll do the same here. I'll divide every line by total assets. Okay, and it doesn't matter if I just use the fill function for the entire balance sheet, because even if I get down here, it's the same number. Just always remember that. So you can use either one of these. Get rid of some zeros, and there you go. Okay, so we can see that we've got less cash now we're looking at this quarter compared to this quarter. So we've got cash represents a smaller portion percentage-wise of our total assets. So we've got less in cash now. Okay? And then down here, nothing much has changed. Okay, nothing much has changed down here. Retained earnings has gone down though. If you take a look, as a percentage of total liabilities and owner's equity, we used to have 2.5% was retained earnings. Now it's 0.08. It's a much smaller percentage. That's a bit scary. Okay, remember we talked about the fact that retained earnings went down, and the main way that could happen would be the fact that we probably experienced a net loss during our first quarter. Okay, and then for our comparative, and I'll just type in this one just as a quick little review, we need to go the current period, and this is what we talked about in class. People said, well, this year minus last year. We're not talking about years here, just remember that. This is this accounting period minus the previous accounting period, and we're looking at quarters. So this quarter, which is end of March, minus the previous quarter. Okay. So we have gone down in cash by $127,649. Remember, this could be seen as a positive if you had too much cash in the bank. Okay. It could also be a negative. Maybe you're using cash to pay off some debt because you didn't make enough money. There's a number of things. You would need to just simply highlight this and go, I want to find out more about this. Okay. Now we would do the same for every single line. So current period minus last period. Okay. And then we would go all the way down. And again, I'm just going to delete some numbers, some zeros here. And these should all be in dollars. Okay, so again we can see that we've gone down. This decrease rate here, so we've increased how much people owe us, because that's account receivable, money that's owed to us. We've decreased our net property and equipment. Remember, that's property and equipment without the depreciation, so you've already taken out depreciation. So we've probably just taken out depreciation in that quarter. That's a very normal thing for our property equipment to go down in value over time, because that's what we do with depreciation. And in here, we increased how much we owe slightly in amount. Okay, and that's really all that is there. Long-term debt, we've reduced it, so we probably just paid off some debt here. This is the big one right here, retained earnings. It's a really big change in value. We've gone down by $132,101. Remember, retained earnings are accumulated profits or losses over the life of the company. So it's a running total. So if it was a positive number by this much, and now to go down to 4,000, that means we probably experienced a loss in that quarter. And then our relative change is going to be our absolute change, which is negative $127,649, divided by the previous period we're comparing it to. Okay, not last year because we're looking at quarters. So $206,781. So we went down by 61.73%. We decreased our cash by that much. See how it looks like an even bigger number now. Okay, so now we're going to do the same. Our absolute difference divided by our previous year, and then we're just going to okay, and then again we would just look for the big jumps. So we've already kind of evaluated these two. We don't know whether the cash is good or bad, but it might not be too good if we start to see this net loss. Okay, we see that accounts receivable have gone up by 33%, so we're concerned because people owe us more money. Accounts payable, we owe more money. We increased that by 7%. Okay, but it seems like we experienced a loss. This is a really big number. Okay, so that's how you could evaluate that. But as mentioned in class, the ratios is where we get a lot of our value. Okay, so current. Okay, so for evaluating our current ratio, always think just current assets, current liabilities. Where does it say current here? So our current ratio is when we're dividing our current assets by our current liabilities to evaluate whether or not we can cover in the short term. So if we had to liquidate, if we had to get rid of all of our assets, could we cover just our current liabilities, the liabilities that we owe in the next 12 months? So we'd go first for the last quarter, $287,178 divided by our total current liabilities, so $241,506. So 1.19, and that's 1.19 times. Okay, so remember, so we can cover our current liabilities with our current assets 1.19 times. So we can just cover them plus a bit more. Now if we look at this quarter, we'll do the same thing. Our current assets divided by our current liabilities. You'll see that all of a sudden, okay, and we'll get rid of that. We're going to just write times over here. That way we remember the fact that, yeah, this is times. So now anything that's below 1 means that if I had to get rid of all of my current assets to cover my current liabilities in the short term, so in the next 12 months, if I had to turn all of this into cash, can I cover everything that I owe in the next 12 months? In 2016, in this quarter, in the previous quarter, I could. In this quarter, I am below 1, which means I can't even cover my immediate liabilities. Okay? My quick asset test. This is going to give us an even more realistic idea as to how we're doing, because we're going to take out inventory, and we would take out our prepaid expenses as well, if we had prepaid expenses. But for now, we're just going to go our current assets, $287,178. And I'm actually going to start with brackets because of bed mass. And I'm going to take out my inventory, so 13,757. I'm going to divide it by my current liabilities. Okay. And the reason why we take out inventory and prepaid expenses, if you remember, it's going to be hard for us to get rid of it in the next 12 months. And when we do get rid of these things, liquidate them, there's a very good chance that our salvage value, how much we're going to make, is not going to be the same as what it's actually valued at on our balance sheet. We're going to lose money probably. Okay. So press enter, so 1.313 times. We'll do the same here. I'll use Excel just to make things quicker. Our current assets minus our inventory, close our brackets, and we're going to divide it by our current liabilities. Okay. So now 0.65 times. Okay. So this number should go down from current because we've taken out some value, so we have less in the current assets. So in previous quarter, we could just barely cover our current liabilities with our current assets without the inventory. Now in this quarter, we're barely covering it. Well, we can't cover it. We're not even covering our current liabilities with our most liquefiable assets. Okay. Working capital this is going to be the difference between current assets and current liabilities. So our current assets are 287,178 minus our current liabilities, which is right here. And remember, this is the only ratio that we look at that is not dividing. Okay, we're not going to divide anything by anything else. We are just looking at our working capital, so we're comparing two numbers. We're just really subtracting current assets minus current liabilities. We're not dividing them. It's really going to show us, if we were to liquefy anything, how much money do we have left over. Okay, so previous quarter, if we were to get rid of all of our current assets and pay off of all of our current liabilities with them, we'd have $45,672 left over. That's our working capital. That's money that we have available to us. Okay. Now if we look at this quarter, so that current assets minus current liabilities, we don't have any working capital. We have a negative number. Okay, so someone who's lending us money, okay, would typically want a positive number to see that we are able to just meet our most basic debt. Okay, but we can't here. Okay, in the short term, in our previous quarter we could, in this quarter we can't. Okay, so if I was a creditor or a lender, I'd be a bit happier with this. Not very happy, because you can just barely cover your current liabilities, but at least you could, and you would have some working capital. Okay, so if I were going to lend you money or put you on credit, I'd be much happier with this than this. Because now, how do I know I'm going to get my money back? You can't cover your current liabilities with your current assets currently, and you don't have any working capital. So a lender wants to see positive working capital, or a creditor, not negative. An investor and an owner is still not going to be very happy with these numbers, but they want something close to 1, and they're okay with the fact that you use a bit more debt. Now when we get to solvency, okay, really all we're doing is, instead of current, now we're going to go the entire company. So we're going to go our total assets, okay, which is, and I'll do it typing it in first, our total assets divided by our total liabilities. So in this case we have to add in our current and our long-term together. So $241,506 plus our long-term debt. Okay, and I'm just adding these two together to find out what my total liabilities are. Okay. So 9.12. Okay, so I have overall, if I compare my assets to my liabilities, I can cover them 9.12 times if I look at total assets compared to total liabilities. I'll do the same thing for these. So total assets divided by my current plus my long-term liabilities. Okay. So 8.85 times I can cover my total liabilities with my total assets. This is a very high solvency ratio. Okay, so what this means is that I can cover my all my debt with all of my assets 9 times over in both. This would be kind of a sign that maybe I'm not using enough long-term debt here, because if I look at how much owner's equity I have compared to debt, okay, and we're actually going to get to that in a second, I'm using a lot of owner's equity here. Okay, that means that I've got more risk. As an owner, I have more risk than my liabilities do. Okay, well, not that my liabilities do, but I just have more risk because I have more money in it compared to my liabilities. Okay, so this is a very high number. My debt to equity, okay, is just what it says. So I'm going to compare my debt. So both of my liabilities, my long-term and my current, I want to divide it by my owner's equity. Okay, and I'm going to do the same here, except I'll just do it quicker. Now this wouldn't be shown as times. Okay. So this means that I have 0.12 times the amount of debt compared to my equity. So lenders look for numbers below 1. Okay, so below 1, that's because you don't have much debt when you compare it to equity. Okay, so 0.12 times. Now, this is even a bit too low. You would want to take on a bit more debt as opposed to equity because you're not using enough debt is what this number means. Okay, an investor and an owner would be very concerned about this because this means that you're barely using any debt when you compare it to equity. That means you have much more equity compared to debt in your company. Okay, so if this company were to go to bankrupt, look at how much equity you have. We can take a look. Owner's equity represents 88.7% of the entire company. Okay, so that would mean that you actually own 88.7% of the assets, but if anything happens, you're actually on the hook. It's a lot more of the owners than it is the debt, and that's why this would be too much owner's equity is what we really see here. Something below 1, yeah, lenders are going to be happy with seeing the fact that you don't have too much debt compared to owner's equity. Owners and investors are going to say this is too risky because there's too much owner's equity involved. Okay. Now for our debt to assets, we're going to take a look at the percentage of assets that are financed through debt. Okay, and this is where we get into a percentage all of a sudden. So we're going to go our total debt again, so our $241,506 plus our $360,018. And we're going to divide that by our total assets, so 5 million some. Okay, so I'm going my total liabilities, which is my total debt, divided by my total assets. Okay? And we need to express this as a percentage. So this is saying that 10.96% of my assets are financed through debt. Okay? And then if we do the same here, and again, I'll just use Excel. Okay, so again, I've gone my total debt, I added these two together in brackets, and then divided by my total assets. Okay, so that's 11.3%. So of my assets, debt finances them only 11% of the time. The rest of the time is all this. Okay, now I'm a bit concerned because as an owner, as an investor, that's not enough debt that's covering my assets. Okay, that means that what's left over, the 80 some percent, okay, that means that that percent is what I own. Okay, so again, it's riskier because I have more of my money included in this company. Okay, so I'm a bit concerned. So that's what those percentages would mean. Lenders want to see a lower number because it shows that you have more money into it, so you don't have too much debt. Okay? They're happy with lower numbers. Owners and investors want to see this number a bit higher. Your times interest earned. That's when we start to look at the income statement. So it's how many times you can cover your interest expense over with your earnings. Okay? So interest expense is kind of a fixed expense. It's what you owe to a bank for taking out debt, a loan. Okay? So they want to know whether or not you can meet just your basic, your most simple interest expense. They want to know that you can just pay that off with your earnings. So let's go over to our statement of income. What we're going to look at is our EBIT, okay? Our EBIT, which is our income before interest and taxes, okay? And we're going to divide it by our interest expense. So I'll use 3D cell referencing because it's going to be easy. Now we can only do this for 1 year because I only want to see for the current year, Q1 2017. So my EBIT divided by my interest expense. Okay, so 4,511 is how much I had in earnings divided by my interest expense. And I'll just press enter. And this is another times. So what this tells us is it tells us that with our earnings, we can cover our interest expense 0.9 times. This is not a good number. This is a very concerning number because that means we can't even cover our interest expenses. Okay? Anything below 2, you're concerned about. 4, you're in a good place. That means that with your earnings, you can cover your interest expense, a fixed expense, 4 times over. Lenders are going to be happy with 4. Anything above 5, an investor and owner is going to think that you may not be using enough debt. Okay, you don't have enough interest expense. So 0.903 times, I'm very concerned about that. Okay, profit margin. Now, this is where we're going to take a look at the income statement. Summary operating statement. Profit margin is your net operating income compared to your total revenue. Now, this is what we've done already in our common size analysis. You've done this before. Okay, so we're really just dividing our net operating income by our total revenue. So it was negative 62.56%, not good in the previous quarter. And then we'll do the same. Negative. So the fact that both of these are negative is not a good thing. The average for Canada is somewhere around 4%, 4.2%. We're not even close to that. Okay. My gross operating profit, okay, as a percentage. Okay, so GOP margin, I'm going to do the same. So my gross operating profit divided by my total revenue. That's not good. And then we're going to do the same for this quarter. Pardon me. Let's do that again. Gross operating profit divided by my total revenue for this quarter. So this is better, at least 9.4%. Okay, 9.44%. That's a bit better. So I'd want to be taking a look at these fixed charges and what happened. So I controlled my costs a lot better as a manager. Now that's why we take a look at the gross operating profit margin a bit more, because this is a number that we have control over. The profit margin later on, we don't have control over it. Okay? And now these operating ratios, this is a bit more straightforward. You should feel comfortable with this, but our occupancy percent is simply how many rooms we sold, not how many guests we had, how many rooms we sold divided by rooms available. Okay. Quarter for this quarter, how many rooms we sold divided by how many rooms available. Okay. So our occupancy percentage was better. Okay. But financially we're not doing too well on the balance sheet. Okay. We did increase our gross operating profit margin. We did increase our profit margin, even though it's still a negative number, but this is still a bit of a concern. Okay. Our average daily rate, so that would be our rooms revenue divided by our rooms sold. And then we do the same for rooms revenue divided by rooms sold. So we've gone down in ADR. Now our RevPAR, we can just multiply these two, right? Occupancy multiplied by ADR. And then we'll do the same here. So our RevPAR has gone up. So that at the end of the day is it's a positive thing. So while our ADR went down, our occupancy went up. And when you combine the two, our RevPAR is going to give us a big picture of these two combined. So overall, we've done a bit better as far as how much we've taken in. Okay, and our gross operating profit per available room, so our GOPAR, is going to be our gross operating profit divided by our rooms available. Okay, that's a negative number. That's never good. Rooms available. So at least we were making some gross operating profit per available room in this quarter. Okay, so the way to kind of evaluate this would be the fact that we're very concerned financially in the short term for this company. Okay, meeting short-term obligations, this company this quarter can't even do it compared to last quarter. Okay, can't cover your current liabilities with your current assets. If you get rid of inventory, you can't cover it. you have a negative working capital. So if you were to liquidate right now, you wouldn't even have enough of your current assets value to cover your current liabilities. So this is not a healthy company right here. Taking a look at these ratios, you would say that, well, this is still too much. You've got too much, you don't have enough, liabilities. This means that you have barely any liabilities covering your assets. And we can see that through how many times you have your debt compared to your equity and how much of your assets are financed by debt. Okay? Only 11.3%. Again, a lender might look favorably on this, but the fact that you can't even cover your current obligations would be a very big concern. Okay? Another concern would be the fact that this company can't even cover their interest expense. Okay? Not even one time over. Remember, anything below 2, a lender is very concerned, and this kind of puts off an alarm for me that this company is not in very good financial health. Okay? Profit margin, sure, we went up. We've got a better profit margin this quarter compared to last quarter, but we're still a negative profit margin. Very big concern again. Gross operating profit, we got a bit more of a gross operating profit margin, but overall our bottom line is not doing well at all. And if we take a look at our occupancy and our hospitality ratios, sure, we went up, but the fact that these percentages are so low, I'm very concerned. This RevPAR is extremely low as well. Gross operating profit per available room, at least we're in the positive. So there are some trends that show that maybe this is going to do a bit better on the income statement, but the overall financial health of this company would be very concerning. Okay? So this is how you would analyze, do the math for the challenged in, and then analyze it as well.